Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I wanted to talk about the markets kind of. I know there's a lot of fear out there. A lot of people are very fearful. I'm seeing things getting sold off left and right. Things are pulling back. I mean, of the entire group, I think gold and silver are looking pretty good. Those seem to be some of the strongest areas. And if I were to just kind of show you, gold's putting in a bullish engulfing pattern on a 1 year perspective. It's right there. So that's a positive development in there. And whenever you get a bullish engulfing, usually that means it wants to go and move on up. The pattern that's bullish engulfing is this guy right here, this one candlestick. And if you were to kind of draw this in here, man, the auto snap is quite dramatic on this. I would say it's kind of there on the closing prices. But this is a bullish engulfing. It's a candlestick saying it's coming down. The momentum is dissipating, and we may have a reversal move to the upside at some point here very shortly. You can see that if I were to kind of zoom in here, we came across and we're coming to the upside here. So that one is looking good. And oil looks like it's trying to make its way upward. We had a big, strong momentum down. We're going sideways here, and we're trying to move on up. Uranium still looks pretty weak to me. This one's broken to the downside. I don't see any reversal patterns or anything yet. So uranium is looking weak. Looking at the price of copper itself, copper, let me go to a 1 year here. There's copper. This is a bullish piercing there, and we just had a small down day today. It's still holding together. It's not blowing out to the downside, at least not yet. Looking at the 1 month, you can kind of see that we've got some support down here. The support's holding. It's doing okay. So copper doesn't look bad. Nickel, let me kind of zoom this guy out some. Going to a 1 year. You can kind of see this ascending wedge pattern that's forming in nickel. And if we break to the downside here, we could see a big move to the downside. If we break to the upside, you can see a big move to the upside. But that's the pattern that I see in nickel, is this kind of squeezing up type pattern here. You could use that one. You could go to this one here and really blow this thing out. No, can't do that. But that's kind of what I'm seeing here, and we could see a potential move to the downside in even nickel if it breaks. It has not broken yet. And then lumber is looking really good. Lumber's broke to the upside. We've got some good momentum here. So lumber's another one that looks, I would say, pretty good when looking at the charts. And looking at like silver, I know we've got a lot of silver bugs here. I'm a silver bug as well. Silver looks like it's firming up. This is on daily. Good, nice candlestick there. Zooming in, you can kind of see we broke this downtrend line to the upside. Platinum looks like it's breaking out of its downtrend to the upside, doing a little back testing. That one's looking better. And palladium looked like it broke its downtrend and it's starting to move on up. So that one's looking very bright as well. But the fear in the market, guys, the fear is it's out there. It's out there. And if we, you know what, let me look at the overall indices here. While I'm here with you guys, we'll do scrolling on down. So the SPX, the S&P 500, let's see what that one's doing. So this is kind of an overall market update here with everything. So when looking at it from a weekly perspective, we got this bearish engulfing pattern right here, which means that we could sell off for a little bit. It doesn't mean that this is necessarily the market top of all market tops, but market tops do usually start with a pattern that could potentially be like this. If we zoom way out, man, this thing looks ridiculous to the upside here. Now you can see these patterns. You get a consolidation and a break, consolidation and a break, consolidation and a break. And each consolidation time frame here from 1968 to 1982, from 2000 to 2013, these here are real estate booms. Real estate boom, real estate boom, real estate boom. And it goes from a real estate boom into a period that is low inflation, low recovery phase of real estate, and then it goes into an expansion phase of real estate. So each of these phases that go sideways are an expansion phase of real estate. What I suspect may happen here is we're going to see a pattern that may do something like, man, if I can draw something like this over time, and then eventually it'll. Sorry, let me do this drawing over again, because that was ridiculous, guys. It'll do something like this. It'll come on up. It'll do one of these. It'll come on up. It'll do this. And then what's going to be created is a pattern that's similar to like something on the lines of this. And then eventually it'll break to the upside and move on up. And this could be squished up a little bit more. I drew it kind of just large. This pattern's probably going to fit somewhere in this like 20, 30 era. It'd be a lot more jammed up, but it's going to be a pattern that looks similar to this if I were to draw it like that. And that's exactly what this pattern is there. And this pattern here. It's the same pattern over and over. This pattern is the same pattern as the one I just drew. It's similar to that. And that's probably what I suspect to happen. That's going to happen in the NASDAQ as well. The NASDAQ's been moving on up. We got this big pattern here. That's when you want to buy. You want to buy right in these points where they're about to break in 2012. Gone. And we're starting to get a little heavy here. This is a bearish, big old bearish pattern here in high volume. It's struggling to move on higher. We're probably going to see potentially more downside here out of the markets. I'm not trying to call a top here. It's very difficult to call tops. Most of the time you get it wrong. One thing I am going to do is throw in a trend line here just to see something. And it looks like we are breaking this trend to the downside here. And then you'll see it probably come up, touch it, and then roll back over. It's potential. Doesn't mean it will. I'm just speculating here. It's really hard to call tops, but if interest rates were to go up, I would say that's the case. Now, with interest rates, we got interest rates here. There's the big interest rate deal here. This was back in the last big expansionary phase of real estate and larger demographic. This was a smaller demographic, and then I think we'll have a bigger demographic coming, but with the fear in the markets, they can manipulate these numbers and get people fearful to run into bonds and lower interest rates or yields. So they're playing that card with the fear game with COVID and the variants. It is in full force right now. Now, usually what happens is you can see what the markets are doing with this 10-year. The 10-year yield, when people are very fearful, they'll run into bonds and the dollar, mainly bonds. And people run into bonds, you'll get this big kind of bull market surge in bonds, and that's probably what we're going to get for the short time frame here. So we could see the stock market come under pressure. We could see stocks kind of roll over, and commodities could go with it as well. What happens though is this stuff on the very short term is very difficult to read, and a lot of it's news driven, and they're trying to pander to fear. So the chart patterns maybe not necessarily help us here because people are, it's very news driven. And when it's news driven, we don't know how long that will necessarily last. The structural underpinnings of this market, and I'll bring up a chart here to show you what I mean by that. The structural underpinnings are strong. And I'm talking about real estate and the housing starts, and that's where inflation would normally come from. But this is all artificially driven. They're printing the money. They're injecting money into the system. They're the ones creating the M2 money supply and the inflation. But historically, whenever we would have strong economies or inflationary aspects, I should say, maybe not strong, but inflationary, We were in expansion phases of real estate, and we're entering an expansion phase of real estate right now. That is a huge, important thing to understand because market crashes generally don't happen. They have not happened in history under an expansionary phase of real estate. We are in an expansionary phase, so I don't suspect a market crash to happen. But if you shut down economies, that's man-made. That's man-made. So there's no control over that. And with the variants and the news that's coming out, it's very difficult to gauge what can happen because it's all man-made at that point. Not the variants, but the response to the variants or the response to whatever news is out there is man-made or controlled by man. These market crashes, they usually happen with too much inventory of real estate and a crash in real estate. That is a deflationary deleveraging bust. So when you have that bust, the M2 money supply goes down, it's disinflationary or deflationary, and things crash and we have recessions. So the expansion or credit phase of leveraging up is almost always accompanied by inflation and increasing interest rates, almost always under an expansionary phase. And that's what we're in. So deflation or deleveraging usually happens when things crash. It doesn't happen when we're leveraging up in an expansionary phase. Now we are in a really weird scenario here where we're in an expansion phase, we're leveraging up, we're building new homes, we're creating that credit. But we've got this virus out here that is also pandering to the fear of people, and people are selling and moving, they don't know what to do, and they're moving all over the place, they're panicking. Is the government going to shut us down? And one, I don't like that political, like they have the control to shut us down. I do not like that. I hate that. But it's a weird dynamic. And it's very difficult to really understand how this is necessarily going to play out and using some of the indicators that we use to see if market crashes are coming. Because if the market crash is going to come, what we would see is a declining 10-year yield. We would see the copper to gold ratio start to fall, which means gold gets stronger, copper drops. And we're seeing that. We saw that today. Copper dropped, gold got stronger. So we're seeing the indications. We're seeing our indicators telling us that potential problems could be coming. The problem is it's based off of fear and news. It's not based off the structural underpinnings that it usually is in the markets. So it's very difficult to know if the readings are legit or if the readings are not, because the structural underlying of this market, what's propping this thing up, is the real estate housing market. And we're in the expansionary phase. We've got the inflation. Everything's there. So it's the news and the variant that's driving it, or some other external factor that's driving this stuff lower. So I'm going to say this: it's very difficult to read, and people who think they have this all figured out, it's going to throw you all over the place. So, some people that said, "Hey, should I carry a little bit more cash?" Maybe. I mean, they're probably going to inflate this thing no matter what. A system cannot live under a deflationary environment. They can't have deflation, because deflation, in terms of monetary deflation, the leveraging up and the destruction of credit. The destruction of credit is deflation. You can't live in a deflationary environment. The states can't, and the government can't, because their revenues will drop. They'll all go bankrupt. So bankruptcy and restructuring debt, I don't think, is on their plate. They're just going to print like heck. They're going to hit the gas, and they're going to say, inflate it away, inflate the debts away. If you have problems, inflate it away. So the system has survived under inflation the entire time. If you look at this M2 money supply, I'm going to zoom in here. We've had the little deflationary bout in 2009. Besides that, we've been in an inflation the entire time. We haven't had a long-term deflation, only the one time in 2009. So I don't see the historical, I don't see history showing us that we've got this deflation problem. And the response that they have has always been inflation. So I think it's going to end up inflation. They printed a whole bunch of money. You can see that huge spike above my head here, right there, that huge black spike. That hasn't manifested itself, and I think we're going to see a big inflationary thing coming. And what I think is going to happen is this is almost like a positioning move. So what I would do is I'd wait for this stuff to kind of drop and bottom out, and then just cost average in and get some cheaper shares. That's what my plan is. And I think everything structurally is intact. So I don't think anything's broken. We have our indicators kind of saying, hey, look, there's fear in the market. But I don't think that's saying that we should be going on and selling everything. But that's up to you. You guys can do whatever you want. But I'm just holding on. I'm positioning myself for more inflation, for the structural move that's coming in front of us with the expansionary phase of real estate, inflation, and the structural deficits in some of these commodities that are going to manifest themselves over the next 5 to 10 years. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.